If you know Warrен Buffett, let's meet his Indian counterpart. This is Mohnish Pabrai, the man who has achieved an annual average return of 25.7% for the past years. His secret? According to Forbes, he doesn't look at companies that look 10% undervalued. No, he is looking to multiply his earnings by a maximum of 5 times in a few years. So if the company doesn't look like the perfect opportunity for this, you can say bye-bye to his investment. Now, his strategy was a hit between 2000 and 2018. He has invested his assets that shot up to 900% after some time, earning him around more than $600 million. So how did this man come up with just a 25% annual return when most of the population struggle to get even just 10%? We're going to break down a few principles for you to follow his footsteps, or at least try. We can't guarantee you'll become the next Warrен Buffett, but fingers crossed that these principles can step up your game when it comes to investing.
Welcome to Financial Market TV. If you're new to the channel and enjoy content like this, hit that subscribe button and the notification bell. Also, please don't hesitate to share your comments down below and give this video a like. Let's get started.
Let's begin with the first principle. The most basic way to get good bargains is to be a cloner. Yep, a cloner, or you might call it a copycat. And for Pabrai, he calls himself a shameless cloner. In the United States, we have what we call 13F fillings, wherein people will publicly file what they own. And when they do this, all you have to do is pinpoint the achievers, or basically the ones with smart investment. When you find them, look at what they're investing into and just go on and do what they do. You see, it's not a deep analysis to get results, since these investors are actually legally required to show the stocks they're owning. And like I said, you have to find the ones that have good investment. You would know this by finding out which one had the history of high returns already. Seeing this will make you trust them more, and of course, after further analyzing, you can copy that investment. You're probably wondering, where in the world can we get this data? Simple. Just go onto what we call the internet, go to Google and search Data Roma. Click on Super Investors category, and there you have it. You now have in front of you a list of some of the wealthiest investors, and of course, a list of what they own when they have publicized. You can check out someone like Bill Gates, for example. When you open up his main home, you can see that recent stocks that he purchased. Go through them one by one, and you can trust Bill Gates as an investor and find his stocks worthy. You can go ahead and invest in them yourself. See? Shameless cloning. Another principle that you can take note of is buying stocks with a moat. What's a moat, you ask? Yes, that is the ditch surrounding a palace or castle to secure them from enemies. In terms of business, it's kind of like a security for your company, an advantage that lets you earn more than the average after a given period of time. So some businesses have narrow moats, some have broad ones, some have deep moats, but can get filled up easily. What you want is a moat that is deep enough that has lots of piranhas in it. What do we mean by this? You would want your company to have its advantage or its remarkable edge that competes with other companies in the industry. The analogy is that if any company tries to take a piece of your business, they would have a hard time getting past your moat. And full of metaphorical piranhas, I might add. To further understand, let's have Facebook as an example. For years and years, other businesses struggle to replicate Facebook or its niche because it has such a sturdy and strong database. So, when you buy a stock, look for its moat and figure out if they have strong piranhas to secure you. The next principle to keep in mind is that you make money by waiting. As Pabrai says, the most unique and biggest edge that you have in terms of value investing is attitude. He calls Charlie Munger's statement that you don't make money when you buy stocks. You make money when you sell stocks. Instead, you make money by waiting. So the key advantage that a value investor can have is not the smarts or who has the biggest IQ. It's the patience. Patience to wait and wait and wait. Waiting for the right pitch. Waiting for even a few years for the right pitch. Pabrai also compared this through Blaise Pascal's words. All of men's miseries derive from not being able to sit in a quiet room alone, stating that this is very similar to an investor's misery of sitting in a room alone doing nothing as well. The next thing to remember is don't engage in short selling. Would you go for an investment wherein your maximum upside is a double, only for you to have total bankruptcy as your maximum downside? That sounds pretty bad and pointless, especially to Pabrai. So you better steer clear of situations like that. Now we have rule number 5, low risk and high uncertainty. This is something Pabrai has taken from the strategies of entrepreneurs such as Patels of India or the Richard Bransons of the world. According to him, there has been misconception about entrepreneurs, and that is they often take risks. They also get their share of success from taking risks. But truth be told, entrepreneurs actually steer their way to dodge taking risks. So no, entrepreneurs are not so interested in taking risks. In fact, they would rather go for free lunches, which is actually pretty sensible. If you take a look at several famous entrepreneurs from Ray Kroc, Herb Schultz, to even Charlie Munger and Buffett himself, you would see that they put their cards more on low-risk bets that have high return chances. It's not high risk with a high return, but instead it's low risk with a probability of a high return. When you look at an investment, Pabrai shares that he also looks at it like his first business. The first question you have to ask is, how can I lose money with this? And importantly, how can I minimize my downside? Call me skeptic, but it's a given fact that upsides will just flow by themselves. So the thing you have to worry about are your downsides, and this is where the checklist steps in. Basically, the keynote to remember if you are a value investor is downside protection. That is also what entrepreneurs tend to keep an eye on, their downside. This is where investors and entrepreneurs can shake their hands and agree on. Next, I mentioned previously that a checklist becomes part of the process. As of now, Pabrai shares his checklist containing around 80 items. Sounds too much? Oh, it's not really. He would take around half an hour to go through it for analysis. What happens is when he starts a business, he goes through the generic process and analysis. But when he is done and all set to go, that is when the checklist steps in. He takes the business through the 80-item checklist, and what happens is there could be a few hits or misses. There may be a few questions that he is unable to give the answer to, and of course, what he needs to further figure out the answers to those questions, so that it stacks up more work to do as you go and search for more answers. Once he is able to find it, he goes through the checklist again. Yes, all of it once more. In any business, there's going to be several red flags, but on the upside, you could be looking at a range of possibilities of what could cause a problem to your business. And this is very helpful, of course. You get all the factors that correspond to your business agenda and goals. At this point, you have to go for a no-go situation wherein you may determine if you are comfortable with all the given factors. If you think these possibilities are safe, then you can go and jump in the investment. Now, what exactly can you see in this checklist? Pabrai has a few examples of what could be part of it. He basically says and owns his mistake in the past and other investors' mistake as well. His first example would be, can this business be decimated by a low-cost country like China, which figures out his competitiveness in the market? Another one would be, is this a win-win business for the entire ecosystem? Let's say there's a company doing well with high-interest credit cards and making a lot of money, but they do not exactly bring any contribution to society. That's why Pabrai often passes up liquor companies, tobacco companies, or even gambling businesses. In one way, they may be doing well and are not bad ideas, but it's still a pass if you want something more useful for everyone. You kind of focus more on its impact as a whole instead of individual points, center court rather than the edge of the court. There may be a few questions on leverage, such as how much leverages there are or what are the covenants. You also get questions analyzing management and their competency, their interests. There's so many questions out there. An example is Dexter's Shoes, where Warren Buffett lost his assets to a low-cost competitor from China. There's also Court Furniture, invested by Charlie Munger. It was an investment made during the dot-com boom where office furniture rentals were at high rate. And this led to the question, are these normalized earnings or boom earnings? So these checklist questions are highly valid, very strong. Because these did not come from thin air, rather they are based on real-life struggles or obstacles that investors went through. But did you know Mohnish actually calls himself a lazy investor? He talks about investing as if it were a leisurely activity. This is quite ironic since what we know about investing includes hard work and dedication. From analyzing stocks one by one to keeping your eyes glued on CNBC every single day. But Mohnish begs to differ and believes that investing can be attained successfully with these simple principles that have been proven throughout history by investors like Warren Buffett and Benjamin Graham. So the secret to successful high returns is actually as simple as the principles we have discussed, thanks to our good old Indian mentor. Not so bad, am I right? We can only hope. And of course, just wait and wait and wait until you don't have to wait for it anymore.
Thanks for watching the whole video. Again, if you're new and like this type of content, subscribe to our channel. And don't forget to leave a comment down below and hit that like button. Also, click on the notification bell to get updated on our weekly uploads. See you in the next video.